Hey, this is John from StopSaving.com and welcome to our second video in our course, Technical Analysis Simplified. In this one, we'll talk about accumulation and distribution cycles and how the big money operates. We'll cover what you need to know about the famous Wyckoff method of investing and how to use it to your advantage. So on that note, let's jump in. So here's what you'll learn in this video. Number one, the difference between accumulation and distribution and why they exist. 2, why the big money buys and sells in smaller chunks. 3, the 4 core phases of the Wyckoff method cycle. And 4, how to use the Wyckoff method to your advantage. Now, you may have heard some people say that it must be easier to trade if you're a big investor with a lot of capital. But actually, this couldn't be further from the truth. You see, big investors or whales impact the price much more than smaller investors or fish. Their big buy or sell orders can make the price move by a lot, and what ends up happening is that they buy or sell at a worse price than what they bargained for. Think of it this way. You're a big investor and you're trying to buy $200 million worth of Bitcoin on a crypto exchange. As soon as you hit the buy button, you're unleashing a lot of buyer demand onto the market all at once. And there likely isn't enough seller supply to meet that demand straight away. So your buy order pushes the price higher to fill all the seller supply. And by the time that's done, you've bought Bitcoin at a much higher price than you would have done if you were only buying a small amount. So to stop this from happening, big investors need to buy in gradually in smaller chunks to build their position without moving the market higher first. And that's called accumulation. When it comes to selling, it's the opposite. Big investors need to sell big positions gradually rather than all at once. That way they can offload their position without crashing the market first. And that's called distribution. While it can be tough to be a whale, the good news is that it can be great to be a small fish. Unlike big investors, small investors don't impact the price when they buy or sell. For example, you could buy half a Bitcoin, 1 Bitcoin, or even 10 Bitcoin on a crypto exchange, and you'd hardly move the needle. This means that as a small investor, you can get in and out of positions much faster and be a lot more nimble when you trade. And as we'll cover more in this video, fish can wait for the whales to choose the direction of the price and then quickly swim in their slipstream. Now, if there's one guy who really understood how the big money operates and how they need to gradually accumulate and distribute positions to fly under the radar, it's this guy right here, Richard Wyckoff. Wyckoff came up with a theory about 100 years ago about what drives market prices. Essentially, Wyckoff believed that big investors control the market, and that they repeatedly take advantage of smaller investors to move the market for their own benefit. Now, I'm sure you've heard of whales playing games to manipulate the market. Well, that's exactly what this is. Wyckoff believed the best way for investors to understand what whales are doing is to think of them all as one big trader called the composite man. The composite man sits behind the scenes manipulating the market for his own benefit. As a trader or investor, you'll do very well for yourself if you understand the game the composite man is playing. But if you don't, you could lose a lot of money. So the trick is to swim with the whales, in other words, trade with them rather than against them. So what exactly is this game the whales are playing? Well, it's all based on something called the Wyckoff price cycle and how big investors control the markets in 4 phases. So imagine this line is a simple price chart. The first phase is accumulation. Here, big investors are deliberately keeping the price lower within an accumulation range so that they have enough time to build their positions. They'll move the price around to try and trick smaller investors into selling so they can scoop up their investments at cheaper prices for themselves. After some time, the whales have soaked up enough seller supply and they're ready for the next phase, the markup. Since there isn't much seller supply left in the market, prices can now move up quickly at this point. This usually draws in a lot more media attention and more buyers. Once the whales have made big profits, they then need to realize those profits by selling their investments, and that's the distribution phase. Just like in the accumulation phase, they'll use all sorts of tricks to try and take advantage of smaller investors. But in this case, they'll make small investors think the price will go higher. This way, the whales can create more buyer demand to soak up their seller supply. Once the whales have sold enough, or potentially loaded up on short positions, they'll unleash the final phase, the markdown phase. Since they've already soaked up most of the buyer demand, there now isn't much left to stop prices from going lower. So that's the 4 phases of the Wyckoff cycle, and these will repeat again and again. Let's now look at Wyckoff accumulation in a bit more detail. As you probably guessed, Wyckoff theory goes deep and can get very technical. This chart comes from stockcharts.com and it shows the different phases within a Wyckoff accumulation. Now fortunately, getting to this level of detail goes beyond the scope of this course, and you don't actually need to know all these acronyms to understand what essentially is going on. Instead, just understand the general pattern. Notice how the price moves within a trading range for a long time before eventually breaking higher at the end. Typically, in these types of accumulation phases, you want to buy when the price is near the bottom of the range and do it gradually to manage risk. You can also buy in once it's clear that the markup phase has started, i.e. once the accumulation range has been broken. And even better, you could buy in if the price has retested the top of the range to confirm it as support. We'll learn more about price support and resistance a bit later on. Of course, in reality, Wyckoff patterns don't have to follow this exact pattern. Here's the Bitcoin low of late 2022, early 2023. Notice how the price moved around in a very choppy trading range with a couple of big drops along the way to scare investors out of their coins. These drops caused a lot of panic and, according to Wyckoff theory, would have given big investors more seller supply to fill their buy orders. And now let's turn our attention to Wyckoff distribution. Remember, this is where big investors will gradually sell their positions in smaller chunks. This way, they can take profits at higher prices without making the market drop too early by selling their investments in massive quantities. Now, just like with Wyckoff accumulation, there's a detailed diagram from stockcharts.com which shows the different phases within the distribution phase. Again, as is the theme of this course, we're really trying to understand what's going on in terms of buyer and seller demand rather than memorize a bunch of terms and jargon. So here, the key thing to understand is that the big money moves the price up and down within the range for a long time. And each time the price gets to the top of the range, smaller traders and investors are led to believe it will go much higher. So they buy in near the top of the range. And that's what gives the whales the demand they need to offload their seller supply into the market. And here's what that looks like in reality, with the Bitcoin top of April-May 2021. Notice how the price consolidated within a range for about 3 months before the eventual markdown phase. This gave the big money enough time to sell their coins to unsuspecting retail investors. And by the time the markdown phase got going, there wasn't much buyer demand left, hence the big drop in price in May. Earlier in this video, I explained how the 4 phases of the Wyckoff price cycle go from accumulation to the markup, to distribution, and finally to the markdown. But while that makes the theory easier to understand, it's not always what happens in reality. This chart shows the Bitcoin price from 2018 to 2023, and I'm looking at the BTC USD ticker 1-week chart. Now in some cases, the accumulation phase comes after a markdown phase, like it did in these 4 times in the shaded green rectangles. Each of these was a major low for Bitcoin after a longer downtrend, and would generally have been a great time to buy the dip. But here's the thing, you can also have accumulation during a strong bull market. In other words, the price can go up first, then reaccumulate before carrying on with the rally. And that's what we have here in the hollow green rectangles. It's the same story with distribution. You can have distribution to signal a major top in the price after a big rally, as shown in these shaded red rectangles. Or you can have a redistribution where big sellers offload their positions during a big downtrend. and that's what we see here in the hollow red rectangles. As an investor, you want to buy during the accumulation phases and sell during the distribution phases. But the problem is, it's not always so easy to tell what the phase is until the final direction has been revealed. For now, just keep this at the back of your mind, and as we go through other videos in this course, it will become clearer how to spot the differences and trade accordingly using technical analysis. So let's now recap what we've covered in this video. Number 1, whales move the market, not small fish. It's easier for small fish to trade without being noticed. 2, the Wyckoff Method describes the market in 4 phases of whale behavior. That's accumulation, the markup, distribution, and the markdown phase. Wyckoff describes big investors as one big trader called the composite man, who pulls the strings of the market for his own benefit. 3. Understanding the composite man's game can help you make better trading decisions. And finally, number 4, it's better to swim with the whales than swim against them. So that's the end of this video and the first section of this course, Introducing Technical Analysis. Hopefully you now know what technical analysis is and how it can help you with your own trading or investment strategy. The next section of this course has 7 videos where we'll dive deeper into price charts and how to understand them. So thanks for watching, and I'll see you again in the next video.